Welcome to today's analysis where we delve deep into the world of exchange-traded funds, specifically SCHD and VYM ETFs. Exchange-traded funds, or ETFs, have become an integral part of many portfolios, offering a way to diversify investments and potentially earn returns. But not all ETFs are created equal, and today we're going to focus on two in particular: the Schwab US Dividend Equity ETF, or SCHD, and the Vanguard High Dividend Yield ETF, or VYM. SCHD and VYM are both ETFs that focus on dividend-paying stocks. They offer investors the opportunity to generate income, in addition to any potential capital gains. These ETFs can be a great option for those looking for a steady income stream, particularly in a low-interest rate environment. But why should you, as an investor, care about these specific ETFs? Well, both have been noted for their performance, their holdings, and their approach to dividend investing. Understanding the nuances of each, their similarities and their differences, can help you make more informed decisions about where to put your money. In this video, we're going to take a closer look at SCHD and VYM. We'll explore what each ETF is, why they've become popular choices among investors, and how they differ from each other. We'll also discuss their pros and cons, so you can better understand if either, or perhaps both, might be a good fit for your investment portfolio. We want to help you get a solid grasp of these two ETFs. By the end of this video, you'll have a clearer understanding of SCHD and VYM, and hopefully you'll be better equipped to decide if they align with your investment strategy and goals. So buckle up and prepare for a deep dive into the world of SCHD and VYM ETFs. We're going to pull back the curtain on these two investment vehicles and give you the information you need to make informed decisions. Now that we've set the stage, let's get down to the nitty-gritty of these two ETFs. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First off, we'll explore the SCHD ETF, an investment option that you might be considering. SCHD, or the Schwab US Dividend Equity ETF, is a fund that tracks a dividend-weighted index of 100 US stocks. It selects these stocks based on four fundamentals: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth. This means the ETF is looking for companies that are financially stable, profitable, and have a history of paying increasing dividends. Over the past decade, SCHD has performed remarkably well. It has consistently outperformed the S&P 500 index, making it a potentially lucrative investment. However, like all investments, it's not without its risks. SCHD is heavily weighted towards large-cap value stocks, which means it may underperform during periods when growth stocks are in favor. Also, it has a high concentration in certain sectors, particularly in technology and consumer discretionary, which may expose investors to sector-specific risks. On the brighter side, SCHD has a low expense ratio, making it a cost-effective option for investors seeking exposure to high-quality dividend-paying US stocks. Plus, its focus on dividend yield and growth can provide a steady income stream for investors, making it a suitable choice for those looking for income as well as growth. What's more, SCHD's emphasis on companies with strong financials means it's less likely to hold firms that may cut their dividends during economic downturns, providing a measure of protection in volatile markets. But who is SCHD suitable for? Primarily, it's for investors seeking a reliable income stream and potential for capital appreciation. It's also a good fit for those who prefer a value-oriented approach and want exposure to large-cap US stocks. However, it may not be the best choice for those seeking diversification across different sectors, or for those with a high-risk tolerance looking for aggressive growth. That wraps up our look at SCHD. Now let's turn our attention to VYM. Now, we shift our focus to the VYM ETF, another popular choice among investors. Let's peel back the layers of the Vanguard High Dividend Yield ETF, more commonly known as VYM. This exchange-traded fund is designed to track the performance of the FTSE High Dividend Yield Index, which comprises U.S. companies with a track record of paying higher than average dividends. In terms of composition, VYM is heavily weighted towards financials and healthcare, followed by consumer services and industrials. This sectoral diversity gives investors exposure to a broad spectrum of the market, while also offering the potential for a stable income stream through dividends. When we look back at the ETF's historical performance, we see that VYM has delivered a steady return over the past decade. The fund's performance often mirrors the broader market, but with a slight edge due to its focus on high-dividend companies. Now let's consider the pros and cons of VYM. On the upside, it offers a higher dividend yield compared to the broader market, providing a steady income stream for investors. The fund is also highly liquid, which means you can buy or sell shares with ease. However, every investment comes with potential downsides. With VYM, the reliance on high-dividend companies can lead to a concentration in certain sectors, potentially increasing risk. Moreover, during periods of rapid growth, VYM might underperform compared to growth-oriented funds. So, who is VYM suitable for? It's a great option for those seeking to generate income through dividends, while also gaining exposure to a broad range of sectors within the US stock market. It's particularly appealing for income-focused investors, those in or near retirement, or those simply looking to diversify their portfolio. With that, we've covered the basics of VYM. Now, how do these two compare? Having understood both SCHD and VYM, it's time to put them head-to-head. When we examine these two exchange-traded funds, SCHD and VYM, we find that they share a common aim of providing investors with exposure to high-dividend-yielding US stocks. However, the way they achieve this differs significantly. Firstly, let's consider the index each ETF tracks. SCHD follows the Dow Jones US Dividend 100 Index, which includes 100 of the highest dividend-yielding US securities. On the other hand, VYM tracks the FTSE High Dividend Yield Index, encompassing a broader range of US stocks with high dividends. This difference in index tracking is reflected in the number of holdings. SCHD holds around 100 stocks, while VYM, with its wider net, holds over 400. This means VYM offers a broader diversification, which can be a crucial factor for risk-averse investors. The expense ratio is another important aspect to consider. SCHD comes with a lower expense ratio of 0.06%, whereas VYM has an expense ratio of 0.08%. Although the difference might seem small, over time, it could significantly impact your returns, especially for long-term investors. When it comes to performance, both ETFs have shown strong results over the past decade. However, SCHD has slightly outperformed VYM in the last 5 years. But remember, past performance is not a guarantee of future results. Finally, let's discuss suitability. If you're looking for a more focused approach with a smaller selection of high-yielding stocks, SCHD might be your choice. But if you prefer a broader diversification in your portfolio, VYM could be a better fit. In conclusion, both ETFs have their strengths and weaknesses. Your choice between SCHD and VYM should align with your investment goals, risk tolerance, and the level of diversification you desire. Now that we've compared SCHD and VYM, it's time to conclude our analysis. We've taken a deep dive into SCHD and VYM ETFs, unraveling their intricacies. We've explored the world of exchange-traded funds, specifically focusing on the Schwab US Dividend Equity ETF, SCHD, and the Vanguard High Dividend Yield ETF, VYM. Our journey took us through the key attributes of each, from their investment strategies to their portfolio compositions, and the types of investors they are best suited for. Looking back, we discovered that SCHD, with its focus on high-quality US companies that have a record of paying dividends, is an appealing option for investors seeking stability and income. Its careful selection process ensures that only companies with strong balance sheets and a history of profitability are included, which could be a comforting factor if you're looking to mitigate risk. On the other hand, we delved into the world of VYM, which casts a wider net in its quest for high-yield stocks. This ETF offers a broader exposure to the market and includes companies of all sizes, making it a suitable choice for those seeking diversification and a higher potential for growth. Both ETFs have their unique strengths, and your choice between the two ultimately hinges on your individual investment goals, risk tolerance, and time horizon. If you're more inclined towards safety and stability, SCHD might be your go-to. But if you're willing to take on more risk for potentially higher returns, then VYM could be worth considering. Remember, investing is not about chasing the highest returns, but about aligning your investments with your financial goals and risk tolerance. It's about finding the balance that works for you, and that's where understanding the nuances of different investment options like SCHD and VYM comes into play. Thank you for joining us today. If you found this video helpful, please remember to subscribe, like, and share with others who might find it useful. Until next time, keep investing wisely.